from why you need to invest, explain what the stock market is, look at the different kinds of things you can invest in, what platforms you should use, how much this is going to cost you, and the best way to do it based on what some of the best investors in the world have said to do. So why invest your money in the first place? Well, I'm sure you're watching this video right now because you want to make more money than you currently have. You may even want to get stinking rich, or at least rich enough so you don't have to worry about money anymore. Whatever your goals, one of the only ways to get there is to invest, which is basically making money from your money. More specifically, making money by using it to buy assets, things that actually increase in value over time. So that's not buying things like new cars, shoes, or handbags, which lose half of their value the moment you use them or drive them away from the dealer or take them out of a shop. Assets could be anything from the property, the house you live in, stocks and shares in companies, or even things like gold. But in this video, we're going to be focusing specifically on investing in the stock market. One of the best investments you could ever make if history is anything to go by. Remember that if you don't invest your money and maybe have it all in cash in a savings account, just like we were all told to do so by our parents and everyone at school, then unfortunately, the bad news is that you'll actually be losing money. Why is this the case? Well, it's all to do with inflation. In short, rather than going into too much detail, inflation is what happens over time, causing your money to lose its value. £1 50 years ago had a lot more buying power than £1 does now. For example, just look at the price of some popular items. Some of the things you might even remember. A loaf of bread in the 1970s was 10p, newspapers were 9p, and a pint at the pub was less than 20p. Well, it's time we got investing. The stock market is the place where the shares of companies and other assets can be bought and sold by anyone. By owning a share in a company, you technically become a shareholder, meaning that you actually now own a part of that business. If you had enough money, you could even buy all of the shares and own the whole business, but let's not get too ahead of ourselves right now. In exactly the same way as you pop down to the supermarket to get your food shop done and browse through the aisles, picking up yet another Terry's chocolate orange on sale for £1. I need to stop eating those. In the stock market, you've got companies who do business all over the world, sell all kinds of things, and they all have different prices depending on how much someone else is willing to pay for it, and also how valuable people think it is. Funny enough, you can actually buy shares in the company that makes Terry's chocolate oranges. It's a European company called Eurazeo. Fun fact for you. Anyway, back to the stock market. There are loads of markets around the world, just like supermarkets, and each country will typically have a major stock market or even multiple ones, like in the US. In the UK here at home, you've probably heard of London Stock Exchange, and this is the place that holds the big UK headquartered companies. You may have heard of some of these like BP, Unilever, AstraZeneca, Sainsbury's, and even JD Sports. All of these companies can be bought and sold by me or you, usually at the click of a button. Just like the supermarkets, you can have different companies being listed on more than one stock market. So don't be surprised if you see the same company in multiple countries, just like you'll see baked beans all over the country. One of the major points about the differences between the stock markets is what currency the shares are bought and sold in. No surprise that everything in the London Stock Exchange is bought in pence and sterling, and everything in the US is traded in dollars. So now we know what the stock market is. Pretty simple to understand. We can only buy shares in companies that are listed on the exchange. Or if you prefer to imagine it, keep the supermarket in your head and imagine all of the different companies as different items on the shelf. Now though comes one of the most difficult questions to answer, and one that has confused investors since time began. What do you actually invest in, and where do you start? Well, let's take a look at that now. So with investing, things can start to get really complicated at this point, but don't worry, I'm going to keep things really simple. As for new investors starting today, it's actually a lot easier than it ever has been. Overall then, here are your choices. On the stock market, you've got thousands of individual companies from all over the world doing all kinds of things. Everything from Apple and Microsoft to Tesco and the National Grid to really, really small companies. However, you've also got funds and ETFs, which I'll explain now. So rather than picking a selection of companies to invest in and trying to work out which ones to buy, which let me tell you, even the best professionals in the world don't have a lot of success with, funds and ETFs are investors' best friends. For beginners, it's my opinion and the opinion of lots of the world's greatest investors that for the vast majority of people, you have no need to invest in individual companies. You don't need to spend countless hours looking at company financials, trying to work out if they're good to invest in, or even have any kind of financial education beyond just some basic maths. This is why in the long term, if you want to save yourself the stress, stick with funds. A fund is a ready-made collection of stocks and shares. So just like a tub of celebration contains all the different kinds of chocolates, even someone that nobody likes, including Bounties, funds and ETFs, which stands for exchange traded funds, just a fancy way of saying that you can buy shares on the stock market just like any other company, come in a huge range and shapes and sizes. One specific type of fund, called an index fund, is probably the single most important creation of the last 50 years for investors. An index fund is a collection of different companies brought together in the same shopping basket because they all share a common attribute. They all feature in an index. Examples of indexes you might have heard of will include the FTSE 100, or the Nasdaq, the Dow Jones, or even the S&P 500. These, just like tubs of sweets, come in all different shapes and sizes. Think of indexes like different leagues in football. You've got the Premier League, the Championship, and all of the rest. The Premier League is an index of the best football teams in the UK, just like the FTSE 100 is an index of the biggest companies in the UK. And over in the US, the S&P 500 is the largest 500 companies headquartered over there. So imagine this, if you owned the Premier League, then every single year you'd make a lot of money and you would not actually care which team won the league. Well, maybe you will. On the other hand, if you had to pick one team which you thought would win the league every year, that is a lot more challenging. You'd have to look at the players, their managers, what they've done in the past, and it would be a lot riskier. Your team could even go bust and run out of money, making you lose everything. And sometimes you'd even make bets just because you support the team, not because they're actually any good. The stock market is almost exactly the same. You can choose individual companies, which are the teams, or you can buy the whole league and own a small part of each team or company. And that way you will win every single year your fair share of the ups and the downs. Also, index funds, especially those which cover the main markets, like the S&P 500, for example, have been proven time and time again to be the most effective way to build your wealth over the long term. Take a note of this. Over the last few decades, index funds, which are not managed by any big-brained investors, have beaten most professional stock pickers, and in fact have beaten professional fund managers over 90% of the time. So therefore, let's stick with using index funds for our investments. They offer us a simple to manage investment, they give us diversification, they provide results over the very long term, and they're also super low cost, something that we'll actually touch on shortly. How simple is that then? By making one investment, maybe every month, you could grow your wealth over the long term and own a small slice of some of the biggest companies in the world. Briefly, let me also touch on bonds because you might see these included in some types of funds, or you might be interested in owning some. A bond is just an IOU. You are effectively lending money to someone, typically a government or a company, and in return, just as the same as you pay your bank interest on your mortgage, bonds pay you back interest once they're completed. Bonds have been a really popular tool as part of a well-balanced portfolio because they are a lot more stable than stock prices. However, they often come with lower returns, so there is a trade-off. Currently, bonds offer very low returns as interest rates are really low around the world, pretty much since the financial crash of 2008. In the past, bonds have returned anything from 4 to 8%, which is great, considering if you're nearly guaranteed, especially if you're buying a bond from a trusted government like the US or the UK. However, in my opinion, right now it's a really hard time to recommend them, and it's not something that I'm personally invested in. Maybe in the future, but right now the returns are just too low, and over the long term, stocks have performed better. So let's stick to funds, and if you agree with that analysis, otherwise feel free to look into more detail in that type of investment. The next question then is, if index funds are great, then how do we know what indexes to buy? Because there are loads of them, just like I've said. Should you invest in the UK, the US, or maybe other countries around the world? Well, thankfully, lots of people out there have already solved this issue for us and created index funds which not only cover single countries, but own shares from all over the world. It's really important when you're investing to make sure that you diversify. And all this means is having lots of different companies who do lots of different things. It's so important to do this for a number of reasons. Firstly, we have no idea what will happen in the future. 2020 and 2021 have taught us that already. We have no idea what companies will do really well and which places in the world will create a new super growth company that will 100x in price. By diversifying, we protect ourselves and our investments, which is extremely important to do. In fact, Warren Buffett loves to remind us, one of the best investors in the world, that he says, rule number 1, don't lose money, and rule number 2, don't forget rule number 1. If we own 100 companies and one of them goes bust, then we only lose 1% of our investment. If we own one company and it goes bust, then we lose 100% of our investment. So make sure you diversify your portfolio. But don't worry, we can take care of most of that by using an index fund. Overall then, what fund might be best? Well, firstly, you need to ask what's best for you. If you're a long-term investor and have at least 5 to 10 years to invest, and you want to grow your wealth and your money, then a broad-based global index fund will be one of the best investments you can make. For me personally, I've invested most of my portfolio into the S&P 500, emerging markets, and also some individual companies. But the majority of it is in index funds. If the top companies in the world increase their profits by 5% each year, then you'll see over the long term, the value of your investments go up. In the short term, each day, each week and month, anything can happen, as you might see on a chart. But over the long term, if a company grows, its value increases and its price will certainly follow. Right, we've agreed that using index funds is the best place to go, and we've also said that we should probably choose one that's global, or at least contains a lot of different types of company. So how do we invest in them? How do we choose one, and what platform will we need to use to get our money invested? Because there are a lot out there. Just before we do that, let me very quickly give you a small selection of global index funds from Vanguard and other providers that you can search for on the different investing platforms. And I'll pop them up on screen now. Just for some context, let me take one of the funds I've listed here and show you what is invested in and help you read the information that's provided to you as an investor. So for simplicity, let me show you a popular global fund that's also an ETF available on pretty much any investing platform. This fund is the Vanguard FTSE All World UCITS ETF. This has a ticker symbol of VWRL. If you want to find it easily, search for that. As you can see, if you go to the Vanguard website and find the What We Offer section, scroll down to Equity, then Global, you'll find it here. Here we can see all of the information we might need. So let's have a look at some of the high-level information. Firstly, we have the price. Because this is a fund and traded as an ETF, it has a share price just like any other company would. By owning shares in this ETF, you therefore are indirectly investing in a huge range of companies. This fund, as we can see, contains 3,816 companies currently, which is a huge number, and they are based all over the world. We can also see its ongoing costs, which is important to note as this is removed from the value of our share over the year as a fee. You'll also see this is a very large fund. There's lots of money invested in this fund. Lots of people and companies have their investments here. It's currently at $8.8 billion. Next, we can look at the past performance, and we can also look at some more details like the fact that this fund actually pays a small dividend. For a long-term investor, it might be a good suggestion to reinvest this money once you get paid it to help grow your wealth even further. To see what the fund is invested in, if you jump over to the portfolio data section, you'll see what companies and where in the world they're based. Reading this here, we see that 62% of the fund is invested in the North American market, the largest in the world, followed closely by Europe and the Pacific. Scrolling further down, we'll see what kinds of companies you're invested in and the different kinds of sectors included. As you'll see, technology makes up a huge part of this fund. As you might already know, big giants like Apple, Microsoft, Google, and Facebook have huge market caps, meaning that they make up a huge proportion of the global economy on their own. This leads us then to the final section on this fund. We can see what the largest companies are in the fund and how much of a percentage of the fund is invested. Pretty much the largest companies will get most of the investments as it's weighted to the size of the company. Anyway, there's loads more information on this page. Make sure to read everything thoroughly so you can make an informed decision. But this is what VWL is currently invested in. Now, time to look at the platforms. Let's take a moment to explain some of the different investing platforms out there. Just like the supermarkets, you can't buy baked beans or Terry's chocolate oranges from the company directly. You will need to use a supermarket. And in the investing world, the supermarkets are called brokers or investing platforms. In the UK, there are loads to choose from, and I'll help you understand some of the main platforms and what they might be best used for. And yes, I've had these on my desk for a while, not really sure why. Whatever platform you choose, please make sure it's regulated by the Financial Conduct Authority in the UK, the FCA. There will be dodgy platforms out there that will try every trick in the book to get your money. Stick with the regulated ones and your money will be protected by the government. That is really, really important. Now, as I'm not paid or sponsored by anyone, I can give you my opinion, what I think are the best platforms to use. If you want to invest in the cheapest, simplest and easiest to use platform, then one of the cornerstones of your portfolio should probably be with Vanguard, especially if you want to stick with those low-cost index funds and invest over the very long term. Not worried about investing in individual companies. Vanguard is the largest provider in the world for index funds, and the founder of the company actually helped create the index fund in the first place back in the 1970s. The most important thing here, which makes a platform good, in my opinion, is the low fees. Just like anything, investing is not free. there'll always be someone taking a cut or a commission somewhere along the line. So if you can reduce those fees and keep them as low as possible, you can end up saving yourself a small fortune in the long run. For example, let me show you how just a small amount of fees can eat into your investments in the long run. I've taken this from Vanguard's website to show you. If we had an investment account with £100,000 over 25 years with a 6% growth rate each year, you can see that you'd end up with a massive £430,000. On the other hand, if you had to worry about costs of just 2% each year, which sounds like a tiny amount of money, you actually only end up with £260,000. So almost 40% of your return would have been wiped out in fees. I've done a couple of different videos explaining fees, so feel free to take a look at my channel after this one and subscribe for more if this has been helpful. Other platforms I use and ones that you might want to take a look at include newer platforms like Freetrade, Hargreaves Lansdown, Stake, and platforms like Interactive Investor, AJ Bell, or even through high street banks like Barclays or even NatWest. Personally, I've got Vanguard, Hargreaves Lansdown, Stake, and Freetrade. This is because I want to use both index funds and trade individual stocks and shares too. So I'm happy to spend a bit more time managing my portfolio and shopping around. But as I said before, index funds will always be a core part of my portfolio as the numbers don't lie and they are a great long-term investing strategy. If you want a step-by-step guide to open an account with Vanguard, please follow the video that I will leave a link to in the description below. But honestly, it's super easy to do, so you don't need me showing you how to do that. The same applies to using platforms like Hargreaves Lansdown as well. Just check out my videos on the channel. Now, just before you run away, eager to get started investing, we do need to touch on a few more points, but thanks anyway for staying with me. In this section, we need to talk about the different types of investing accounts and explain what the differences are. In the UK, we've got several account types open to us, and it's important to choose the right one so we can give ourselves the best chance of building our wealth and making money in the long run. The biggest consideration for the type of account is really about reducing as much as possible any kind of costs, which includes tax. On most platforms, but not all, you'll see different types of accounts. A stocks and shares ISA, a general investing account, a self-invested personal pension, or SIP, and also a junior ISA. To get started and to get us moving for the long run, it would be best to use a stocks and shares ISA, in my opinion, for a number of reasons. This is an individual savings account open to all UK residents aged 18 or over that allows you to invest into the stock market tax-free, meaning that over the long run, any gains you make are all yours to keep. Now tell me something that sounds better than that. Okay, other than eating another chocolate orange. A stocks and shares ISA allows you to invest up to £20,000 per tax year, so that's all the way from April through to March each year. You can open as many accounts as you want across different platforms. For example, I've got one with Vanguard and one with Hargreaves Lansdown, but the rules state that you can only contribute to one per year. So just take note of this, otherwise you'll probably end up getting in a muddle with a taxman potentially. £20,000 per year is going to be far more than enough for 95% of the people in the UK. But if you do need another account outside of this, then feel free to also have a general investing account, sometimes shortened down to GIA. I've personally got multiple ones of these across many platforms, but please remember that it is a taxable account, so any massive gains or dividends will be subject to tax outside of all of the different allowances that you get. Just quickly going back to the other accounts, you can use a SIP to manage your own workplace pensions from any old employers. And also you can open a junior stocks and shares ISA for any child under the age of 18. And once they turn 18, it then becomes theirs and it becomes a full-blown stocks and shares ISA account. Very nice of you if you can do that for your kids. They'll thank you in the years ahead, or they might end up rebelling and spending it on something stupid. You may want to talk to them about investing before they turn 18. To give you some kind of inspiration, if you were to invest £20,000 per year in your stocks and shares ISA and get a return of say 8% a year, over a period of 20 years, you end up with nearly a £1 million investment portfolio, of which over half is from gains. This is why compound interest really is the eighth wonder of the world. So you've got your stocks and shares ISA set up, you've chosen to invest in a global low-cost index fund, and you're looking at your account on Vanguard or another platform ready to invest. But now you've got the age-old question. How much do I invest now? Do I put it all in at once, do it every month, or try and wait until we have a market crash? So many people have asked this question and continue to look at it all the time. Over the past few years, the stock market has been doing really well. Anyone getting started has always had the worry that they're investing right at the very top or when it is the most expensive. What this ends up doing is making people worried. So they end up doing nothing at all, waiting with their cash, trying to time the market and buy on the dip or the next market crash. The issue with that is that trying to time the market doesn't work, and nobody knows when or if the market will crash next. If people did, then investing would be easy, but actually It would not even work, as people would be buying and selling based on what they already know will happen. Just take 2020 as a prime example. Who could have predicted that? Luckily for us, there's been countless studies done on this subject using data from the past 100 years in the stock market, across all of the booms and the busts, putting money at different times and seeing how it would have performed. I'll let you go back into these studies in more detail if you like. Just search for them from Vanguard and Fidelity, and some others too. But in summary, here are the major takeaways that should give you some reassurances. Over the long run, investing in a lump sum amount of money beats trying to put money in every month most of the time, around 60 to 70% of the time. However, most people will invest every month when they get paid and don't have thousands of pounds hanging around in a bank account. Technically, this is lump sum investing. You're taking all the money you have to invest, maybe £100 or £200 per month, and investing it into your fund, regardless of the price. However, you could also call this dollar cost averaging, which is just a fancy way of saying investing consistently over time, as you're getting different prices every time for your investment. In all honesty though, the best way to invest, whether it be all at once or over many months, really depends on how you feel about it. If it makes you feel more comfortable to invest every month rather than save up and then go in later, that is completely fine. Do what you want to do. After all, personal finance is just that. It's personal to the individual. Regardless of the outcome and what the data says, do what is right for you. But please just do something, otherwise you will lose money with inflation and you never know when the best or worst days is going to be on the stock market. Here's the best thing about investing. The longer you invest, the more chance you have at making your money grow as big as possible. Almost every investor you meet will tell you that they wish they'd started earlier. Even Warren Buffett himself, who bought his first shares before he was even a teenager. Also, investing over longer periods of time means that you will smooth out all of the ups and downs that the stock market can go through over time. But most importantly, it's all about compound interest. Given enough time, a small amount of money left to invest, getting say 10% per year, for example, can turn into a huge sum of money. In fact, that's about what the average return has been for the S&P 500 over the last 100 years. Don't be put off thinking that you haven't got enough money and it won't make a difference, because it really will. And the most important factor is consistency and time combined. Once you start getting interest on top of your interest, things really start to take off. If we take another example of compound interest, let's take £1,000 and make it into £1 million. Given enough time, anything is possible. At a rate of interest of 10%, after 70 years, your £1,000 with nothing more added becomes £1 million. Now just imagine if you could add money to that every month. You'd be able to shorten that timescale down a lot more so you can actually enjoy your money. For a crazy example, how cool is this? If we say that we invest 100 years rather than 70 with the same amount, we end up with £21 million. So the next time you're thinking about Christmas presents, how about an investment for your kids or their grandkids that gives them £20 million to start off with? Not bad at all. Yes, you can lose money in the stock market. Many people have and many people continue to do so. But there is a difference between long-term investing and trading, which is more short-term oriented and riskier. Choosing individual stocks, buying them because you think they'll go up next week or because someone told you it was a dead cert that this company would increase in price, is almost always a bad move. Putting all of your money onto one stock for just a short period of time, and even a long one, is asking for trouble, and is similar to only going to the supermarket and buying only cans of beans for breakfast, lunch and dinner and to drink. Even the best investors in the world will hold multiple positions because nobody knows what the future will hold, and there are plenty of unknown unknowns. Basically, things we have no control over and we've not even thought about. If you invest with a long-term time horizon, something like at least 5 years, ideally much longer, and you choose a broadly diversified portfolio using index funds, you'll benefit from the returns of the market, which have historically trended in one direction, up. There are plenty of speed bumps along the way, but as companies drive growth, people come up with innovative ideas to make money and impact the way we live, creating real value. The global economy will grow. Essentially, if we look at historical data, if we invest for periods of longer than 20 years, there is almost no time horizon that we lose money, even if we bought at the worst possible time. So don't confuse long-term investing with speculative trading. Long-term investing is like owning a casino, and trading is like playing the games inside it. You can sometimes win, but most people lose money, and the house always has the edge. Once you have an account open, have set up your first investment, and maybe also started a direct debit every month, you're pretty much done with everything you need to do. There'll only ever be a couple of different things you need to keep an eye on once you have everything in place. Firstly, make sure that you're set up to pay your account fees, which, depending on the platform, might need to be paid in cash on your account, a debit card, or even through direct debit. Vanguard, for example, allows you to pay your fees with money in your account, debit cards, and also direct debit. But Hargreaves Lansdown, for example, needs to have cash in your account. Otherwise, your investments will be sold to pay them. Ideally, make sure you understand this, as it might only be a small amount of cash, but it will add up over time. And ideally, you want to have that money working for you. Secondly, if you are invested into a fund that's an ETF, there might also be dividend payments provided to you. Funds are broken down into two categories. You've got accumulation and distributing. Accumulation funds do not pay out their income and will reinvest it for you automatically, whereas distributing funds will pay you out a dividend. This is typically because the companies inside of them also pay a dividend, so you'll get your fair share of that. Now, depending on the platform, you might get an email letting you know that you've received the cash, or sometimes nothing at all. So it's best worth checking several times a year in case this happens. But other than that, just leave it to do its thing and stay consistent. Although, especially when I started many years ago, I checked multiple times per day on my accounts. And to be honest, I still do, because I clearly have nothing better to do. So that's everything you need to get started. There is still so much we can talk about and all of the details, but I have made lots of other videos on this topic. So please check out my channel for this information. I'm going to also have a new playlist all about investing for beginners in the UK for 2022. So please check that out. Like the video if you found it useful, subscribe for many more. I will see you guys in the next one. But as always, and for the new ones, happy investing.